There are a lot of questions being asked of the markets at the moment, with indices at record highs. We've got the S&P 500 just teetering on the brink of closing above the 5,000 level. That will be a seminal moment in the history of the markets. And we're seeing records on this side of the Atlantic as well for the German DAX. The big question is, how far up does it go before there is a correction, if indeed there ever is a correction? Doubtless it'll come at some point. It's just a question of what's going to trigger it. Let's take a look into more detail now about the technicals around this and talk as well about some of the fundamentals with a regular guest here at IGTV, Ron Williams from RW Advisory. Ron, welcome.
Thank you.
As we speak, as I said, we got the S&P 500 teetering on that new record close again today. What is it about the risk on trade that we should be focusing on?
Well, the timeless Sinatra classic of Fly Me to the Moon is still on, although the underside of that is and back again, as markets potentially normalize to Earth's gravity at some point this year. So the big call is, watch out, start developing those risk scenarios, at least short-term tactical, and potentially into the US election time period of November, where we're likely going to get more of a volatile mean reversion environment, in which case we should start to lighten up and profit take where possible and start to apply some tactical overlays.
Yeah, let's bring up your first chart where you've got a breakdown. We've seen these sort of charts before from you, so they're quite easily understood. Let's just quickly talk us through, because we want some pointers from you to understand exactly what it is you're trying to tell here in terms of the messaging.
So this is a global cross-asset radar screen that is used actively at RW Advisory. It looks at different cycle points, long-term strategic, medium-term tactical, and short-term active. They're the columns from left to right. And essentially what we're seeing is that risk-on move, although there is a little bit of dispersion and rotation. US are clearly up there, as you just mentioned, S&P 500, testing that 5,000 randophobia level or glass ceiling, whichever way you want to look at it. But Japan actually outperforming last month of Jan up to about 15%. In that 1 month, just 10% from its 1989 peak levels, a lot better attractive value there. We've spoken about Japan before. Mm-hmm. So different plays at different stages of the cycle, but essentially USA, Japan, India priced to perfection, consolidating in the short term. And then on the second half of that same table, you see interest rates down from their 5% handle, looking at long-term US 10-year. That is likely a support level for now. We can refer to it in a moment. But essentially, that's the cross-asset mix. Risk on still elevated, but for how long? And the analysis is suggesting that we are going to get a rotation soon. Now, if we look at the chart on the top right-hand side, figure 2, that just shows how strong this bounce back has been in risk on equity markets, in particular S&P 500. The November rally into December and January this year was the biggest on record in 30 years, to the tune of about 20% now, if you add the latest data point. But it's super overbought, due a healthy correction, and an opportune time to take profit. The bottom chart on the right shows the standard deviations of some of those risk markets, USA, Bitcoin, and world, also hitting 2 standard deviations from the historical mean.
Yeah, that's the big question, isn't it? I mean, talking about the when it's going to reverse, one assumes that at some point there's going to be some sort of an unwinding. Let me just bring up a chart of the S&P 500, because I think it's worth looking at this in the context of real-time data. And you mentioned that 5,000 level. This is the red dotted line at the top here. I'm reminded of a quote by Chuck Prince, the chief executive of Citigroup at the time of the financial crisis. He was asked by a congressional inquisitorial team that had got up there. They got him on the seat, and they're saying, why is it that all you central bankers wanted to continue to go into these markets knowing that they were at too heady levels? The point he was making is the fact it's a dance. You've got to keep dancing until the music stops. And if you're not seen to be doing that, you're not seen to be taking part in profits. You've got to look at this chart. People aren't going to want to be short on this because they're not going to want to miss out. This causes a sort of tension in the market, doesn't it? And it almost takes it up beyond the point at which it's sensible. Do you think we're getting to those levels at the moment? How do you interpret what we've got here from what you've just said?
It's great to dance to the music while it's still on, but as many astute investors will say, you need to get off the dance floor when that rhythm stops. And in behavioral terms, we're talking about FOMO versus FOLO. Yeah. Fear of missing out, greed, fear of and FOLO, fear of losing out, the risk side of every risk-reward profile. So essentially, last year was the year for greed. This year is the year for some kind of consolidation, cyclical market timing overlay, in which risk management will apply more due diligence. So we need to make that important transition between the two. Nothing goes up in a straight line forever. Markets have taught that to us time and time again. So at the very least, we should be maybe thinking a barbell strategy, keep some risk trades on, take profits where possible while building some downside hedges, just in case we get some of those risks now. Let's not forget the market is now less obsessed with inflation, given that it's half of what it used to be, and central bank policy, given most of it's been priced in, at least in the US. And there's a greater focus now on market elevated levels, but also broadening geopolitical risks, which remain here. And so that will likely change the themes that people look at in the year of 2024. Looking at the chart there on the IG platform, a picture speaks 1,000 words, especially when it's so simple and so clear. The channel rising from the October lows of 2022, which clips the November drawdown in 2023, gives you the top side channel target of 5,000. So we're here. Big roundophobia or glass ceiling level, whichever way investors or traders want to look at it, but certainly an inflection point from a tactical perspective where the market may pause and either unwind, which would be a healthy move, or continue higher. We need to get a confirmation on a weekly chart at the very least for that follow through. But certainly a good profit taking opportunity with the inflection point likely ahead.
Okay, well let's go back to your charts now and take a look in some more detail. If we drill down into that and get some more detail and get your next chart up, because there's some more analysis in here which you can perhaps maybe extrapolate from to give us some more depth and analysis as to what's happening.
Well, these three mosaic charts underline the key headwinds: momentum extremes, rotation fragility, and timing asymmetric risk. Momentum extremes we've already discussed, but when you look at the short-term chart, you can see there's another channel that we can look at, but this time on the low side, it shows near-term support near the 20-day average, also 4,800, which is approximately where the 50-day average is, and that's an important regression line on the chart. Either way, if we get a short-term tactical reversal below these levels, expect a healthy unwind, and the likely downside risk would be at least 10% into 44.50, which is also where the long-term trend average is. Now that's momentum. Look at the rotation fragility. This has been a story for most of last year, and FANG and MAG 7, some of them have now unwound and failed, but nonetheless, for most of last year, they were the big upside surprise, and they held their winning form for most of that time. But we're now starting to see deterioration, not just in broad stocks across each of the equity markets, but also in tech and also in FANG or MAG 7. Already we've seen a few moves just recently. Yeah. So that's a sign that leadership is narrowing, even within tech, and further downside pressure likely ahead. And then last but not least, on the timing side, although this has been overstretched for a while now, a cycle model developed by the Foundation Study of Cycles in the bottom right, figure 3, showing that we're likely going to have a two-stage move, one down in the next few weeks, certainly within Q1, likely elevated volatile environment thereafter. We could get a new high, whether it's a new all-time high or not, we'll see, but certainly a new high. But either way, into the summer and likely the November US election period, further volatility ahead. So we're going to likely have a very different market environment this year. One of my big calls at RWA is a big non-consensus change in both equities and bonds.
You briefly mentioned the bond markets there. Let's take a look in some more detail about what's been happening there, because that is also part of this big picture story.
Yes, absolutely. So there has been a tilt back in November last year for the last 3 months, pricing in the so-called Fed dovish pivot. It's now official. But when will the cut be? We now have it pushed into likely summer, June period, with a little bit of a shaky 60-minute interview with Chairman Powell, getting the market at asking, and reassessing that same policy question. Having said all of that, the market already priced it in. As I just mentioned, sentiment indicators are suggesting it was likely over optimistic, but also aggressive in terms of number of rate cuts and, of course, timing. The vulnerability to a policy mistake and or recession is still there. And either way, the tactical and long-term analysis on rates is that the lows are in. And the key support levels around 4%, approximately where the 200-day trend average is, where markets tend to mean revert. And likely we will have a pattern repetition of what happened in October 2022, where after we had the big drop, we triggered another uptrend, this time back to the 5% historical threshold. And yes, it is a historical threshold. If you look at the top right-hand chart, figure 2, a chart which has done the rounds many times across many research reports. If you go back 100 years, 5% is that line in the sand for the market. And we're likely to not only retest, but spike through that, and in time maybe break above it. Something for us to keep in mind, particularly for those who are looking at a historical analog, such as I am, of the 1970s, way back when we had rolling waves of inflation volatility. This is not directional, it's two-way, and ultimately it's higher for longer, but with a disruptive volatile regime. We've been there before, we're likely to do it again. Different macro backdrop, we're probably close to 08 in terms of the debt challenge, but certainly in terms of inflation, volatility, and maybe stagflation. 1970s. And if you look at the chart there closely, the orange line is current CPI, looking like it's making a low. We could head down lower, but essentially that's the low before the greater sequential wave up, which is that much greater.
It's interesting, isn't it, talking about what's happening with what's going on in the market at the moment and the relationship with past years. Just as another anecdotal piece of information that I picked up recently, so I was talking about the rhythms in the markets, the rhyming and so forth we so often talk about. And that if you do go back to the 1970s and start to extrapolate some of what happened then into what's happened now, and I was reminded, of course, that we're in a very different picture. Technology is different, supply chains are very different for a number of different reasons. Yes, we're still facing war. There was wars in the 1970s, of course, but there are some, as you mentioned, fundamental differences perhaps maybe than there were in the 1970s that might also be something that might not necessarily give us the same direction of travel. But I take your point, the fact that the markets are overbought, the markets are due some sort of a correction, and that rates are possibly maybe to go up. But I think the question is, out of all this, doesn't matter what happens, how do we make money out of this? And that's really what I want to get to with you to get to the nub of the point.
Yes, absolutely. And just to your point there, it is the pattern rhyme in this case, inflation volatility with an equity market regime that tends to mean revert, and also the broadening geopolitical risk of both now and the 70s. That's what we do have in common. But of course, the debt situation is different, more similar to 08 and maybe past examples. So macro is different. It's the pattern rhyme, not the repetition. And it's more the actual pattern itself. But a very good point that you make. And then circling back to, well, what do we do in an environment like this and how do we make money? It's actually a rotation which is becoming well known, but more and more investors and traders should be having this on their radar, for this whole year, but probably from the second half into 2025, when we start to rebalance our portfolio and start to shift to a different asset class, and that is real asset or hard asset, as it's otherwise known, commodities, part of the inflation story and the whole debt reset that's required for us to move into a new cycle. essentially, when you plot commodities versus equities, you see this generational rotation between the two, which does happen time and time again. The last time was Tech 2000, 1999. And then before that, the 1972 Nifty 50 stock bubble. Each time was a peak in irrational exuberance, and then you see the pendulum shift the other way. We're now verging on a commodity super cycle where there's still time to get some exposure. We're already seeing some upside in the energy market. We've seen some cyclical opportunities in agriculture, food, and of course, if going back to your point about supply side shortages, there's likely risk of that in the food market past and in the future. And then let's not forget precious metals, which is still looking quite positive. Now, two quick points to make here. The rest of the market is on the opposite side in sentiment terms on the inflation story. So you can see in the top right-hand chart a survey from Bank of America with their investor base showing that nobody, according to their data, is expecting higher inflation. That is a historic low, lower than the 2008 last print of the same survey. And so it implies a pain trade of sorts where the so-called crowd wisdom is likely on the wrong side of this particular inflection point. We should study the crowd, trade the crowd, but not be vulnerable to the crowd, especially at these extremes. And then lastly, in terms of tangible portfolio positioning, the acronym is FANG 2.0. And that's also developed by Bank of America. It's a portfolio mix of industries, not stocks, which are mostly commodities, inflation robust, and also tend to fare better during volatile or geopolitical environments. That's F for fuel, A for aerospace and defense, second A for agriculture, N for nuclear and alternatives, and then the big G for gold. Last time we had a shake-up in tech, FANG 1.0, mega cap growth stocks, it was a fall from grace, 50% on the index down. They still went back up again, and I'm sure they'll continue to perform well in years to come, but they do unwind as they did in 2022. And back then, there was a 60% performance gap between the two, in favor of FANG 2.0 versus the former. So something for people to keep in mind as a risk scenario, a risk reward scenario, I should say, if we get another rotation at some point in time this year or thereafter.
You mentioned it briefly, precious metals. We've got to talk about that because that plays an important part, doesn't it, about hedging against certain risks in the market. And your final chart is about breakout targets for gold, which as a gold investor, I'm encouraged by. I've been frustrated very recently by the fact that it's not going anywhere. So it'll be interesting to see what you have to say. But clearly, there is potential upside from your tactical planning.
Yes, tactical and strategic gold has, for the most part, been testing and breaking above that 2,000 glass ceiling in dollar terms. Yep. I do share your frustration that for the last few years, it's been very volatile, up and down, and in absolute or sometimes relative terms, it hasn't performed as much, particularly when you have roller coaster markets to the upside, as we did in last year. But if we get a rotation and an unwind, then markets like gold will shine again. And we're already seeing that taking place right now into the new year of 2024, where the gold market has pushed up again impulsively and is holding at what is now support, the $2,000 mark. Also worth keeping in mind the factors that are driving this. So one, this is still currency debasement. Our money is losing its value on a regular basis due to the debt global phenomena. You can see that when you look at gold across other currencies, it's the rising tide of gold that is advancing and outperforming other currencies. You can look at that on top right-hand chart, figure 2, which shows gold against world currencies. Currently, I counted gold outperforming to all-time highs of at least 6 fiat currencies right now. Right. So it's already strong. It just tends to deviate on the dollar because the dollar's been sideways to up this year so far. But be aware of the debasement story. Be aware of record central bank purchases, which was the story for last year. I think it was at a 50-year record high, and that's for good reason, diversification play on their part. And then last but not least, this gold remains a safe haven. look at the chart, main one on the left, last year was a safe haven story for gold. We had the Silicon Valley bank panic of March last year, gold jolted up. And then, of course, in Q4, around about October time, we had the Middle East tensions with the Israeli Hamas war, which continues now, and people are, geopolitical experts, talking about a potential conflict overspill. Time will tell. But if you're looking at certainly Red Sea strikes and how that is creating a potential inflation spike story in terms of global trade, and of course, you know, how that whole story may prevail, not just there, but Ukraine, Russia, Taiwan after the elections. We'll see how that may impact US-China relations. We're moving back into that multipolar world where there is more disruption, where deglobalization creates a very different regime and geopolitical risk premium increases. And this is the gold world. And if we look at the chart in figure 3, remember that gold does spike during times of shock or crisis. 1980 and 1973, it did so by up to $700.
Which would take us up to that 700 to 800 level in current pricing.
Yes, so inflation adjusted, depending on which numbers you used, it's a minimum of that, if not higher. Some people quote 3,000 as the next big figure for gold. But essentially, we could get there pretty quick if we get a range of those factors playing in at different times or at the same time. Currency debasement, of course, the safe haven flow, and then further demand, whether it be investor, retail, or central bank.
Yeah. But the message is, going back to one of the first charts, is that the S&P 500 is looking toppy, opportunity to sell sometime in the not too distant future, I guess. That's your main scenario, isn't it?
Yes, a two-stage corrective move, one here and now going into the month of Feb and Q1 in general. We could get elevation thereafter where we get another high. We'll have to wait to see whether it's a new high. But essentially, a volatile market environment with the next down wave into the US elections come around November this year.
Big election year. Okay, all right. Ron, thanks so much indeed. Ron William from RW Advisory with his view on the markets as we look to that S&P 500, just about looking as though it wants to close above the 5,000 level, an historic high.